welcome. There's strength in numbers, okay? This is such a great panel. And we have an hour to speak about alternative investments and alternative strategies, first of all. How family offices can think about them, adopt them. If they're not doing anything, how do you start? If you're already in it, what should you add? And how this is obviously uncorrelated strategies and how you can benefit from them this year, right, in 2023. And we're also very, very interested in exactly what you're doing and, in the details, right, of your current funds and projects. So we're gonna go ladies first. Eveline Gerck is an investor, an advisor, and a board member to a number of family offices, right? And now you have a very exciting project that you're working on. It's called K Funds. And so I'm sure that we're gonna hear about that. Welcome. And then we have Will Kai, who not only overlapped with me at JP Morgan, he's also a fellow NYU alum. So welcome. And he is the co-founder and managing partner of Wilshire Phoenix. It's a firm that focuses on regulatorily compliant crypto investment products. And you have a lot of stuff, as we know. Okay, so I'll just go in that direction.
Yeah, no worries.
We're gonna go in a circle.
There
Okay.
you guys are.
Oh, yay. Okay, this is good. I like that. This is great. Okay. Robert Cote. No, seriously, this is like amazing. Robert Cote is the CEO of Cote Capital. Cote. I'm so sorry. Robert Cote is the CEO of Cote Capital and one of the world's leading IP lawyers and investors. And we're gonna learn everything about that. And I see Peter, who is also in IP,
Hello.
making his way here. Great overlaps. Okay, Blake. Blake Singer is the managing director at Amera Securities. He is a financial services and wealth management executive who is focused not just on traditional investment management, but also alts, private equity, international trade finance, and he's essentially a chief investment officer. Right? And then last but not least, Giles Friedberg is the chief operating officer of Libertas. And Libertas is a specialty finance company that has provided access to over 1.9 billion of funding to small and medium-sized businesses in all 50 states. So welcome. What a great panel. And Eveline, let's kick this off. You are on the board of family offices. So how should family offices think of alts strategies?
Yeah, so currently the last family office that I was with, which is a $2 billion family office that had, they were in the US and they had mostly money from Asia and China. So in that type of strategy for them, they wanted to invest only in the US. And I was a venture partner there for 2 years, and my job was basically to find the deals and work them until we invested. And that type of strategy for them at the beginning went really, really well. They invested in top companies like Data Robot, like DigitalOcean and Uber and so on. But as they got more and more direct investments, they only wanted to do direct investments, not go through funds. They were in the eyes of a number of other players. And it was really hard for us to pass through the rover when we had like major US venture capital funds. So my lesson there is that when you are so big, instead of only trying, even if you build they have more than 50 employees looking at companies to invest directly. So it's like they are a fund. So I think that they're changing a little bit their strategy to invest more in funds. So the funds would invest in the companies. So this is a lesson that I learned, that even if you want to invest directly in companies as a family office, it's going to be get a point you're going to be competing with the funds and you lose all the time. So I think you definitely have to go to funds. That's my experience.
I think that's an interesting perspective. I think if you take a step back though, and Blake and I were just talking about this before, alternative investments today are very different than alternative investments years ago. Right? So things that were considered alternative investments 10 or 15 years ago are run-of-the-mill, down the fairway investments today. So my advice to family offices would be to look more afield at what some might consider more esoteric asset classes. The whole point of alternatives is to provide diversification, uncorrelated returns versus what's going on. And I think what most family offices get caught up in is definitions of the past, long, short, distress. These are considered alternatives, but there's a ton of capital that goes into them. Looking at more esoteric asset classes, things that, for example, Libertas provides single family offices. Blake and I were talking about very interesting trade finance opportunities. So I would propose that if family offices are looking for alternatives, they look for much more esoteric areas that don't have as much capital chasing after them, and areas that really truly offer differentiated returns from what are run-of-the-mill alternatives or what people have talked about alternatives for the last 2 decades.
Wonderful.
I was just going to add to that. In kind of on the frontier of alternative, if you will, and to pair what Charles said, what used to be alternative is really mainline now. And so I think it's important for a family office first to determine, do they want to really increase their wealth or do they want to maintain it? And certain generations within a family have different perspectives, right? So that's going to dictate whether they're more on the long ball side or the venture side versus the spread side, which is, clipping big coupons, so to speak. They're not mutually exclusive.
I just want to support your conversation, which is that today there's more than $1 trillion in liquid hedge fund strategies.
Yeah.
Right. And there's a platform that offers SMAs to family offices that has more than $50 billion of assets on it. So that's on a daily liquidity basis.
It's like Garrison Keillor, right? Not everybody can be above average. And when you've got that much money floating into what's called alternative, spreads get really tight really quick. And the worst scenario is what we call a crowded trade, where everybody tries to get to the exit at the same time, and it gets ugly. So, look for areas where there are moats around the strategy, moats around the spread that they're doing. There's expertise and there's niche. Okay.
Yeah, if there's funds that exist, that means a lot of people are probably going into it. So the counterpoint to using funds is, funds are things that a lot of people are looking at. For example, if we have a unique partnership with single family offices where we allow them to participate side by side with our balance sheet capital. It's not a fund, it's in their name. They're basically relying upon us to do all the underwriting and they're getting the benefit of participating side by side on a pari basis. That's alternative to a traditional approach of investing capital.
Great. We'll get into your specific funds. I want to kind of general remarks. Robert, go ahead.
That's probably a good segue for me. So we all live in this world of the world that exists, and we live by habits of thought. We like to operate where we're comfortable. That's why you see lots of money poured in. That's why you saw manufacturing get outsourced, right? When we don't innovate in a space, and to your point, create new strategy, we lose the advantage that makes it attractive. Everyone can do it, and then we live at the average. That doesn't allow our country to grow. So I have an alternative strategy that is IP investing instead of equity investing. If you want me to get into it, I can share a little bit of that. Up to you. Yeah.
We'll go to Will,
Okay.
and then we'll delve deeper into what each of you is doing. Is that right? Okay.
Thanks,
Go
Julie.
ahead.
No, I
Yeah.
want to echo what
Yeah.
everyone else has said on the panel, especially last year, 2022, and upcoming 2023. There's going to be a lot of volatility. I think I'm glad to be on this panel of attorney strategies and investments. Keep your mind open. Don't shut your mind off a segment strategy potentially didn't work, or maybe a few years ago we thought it wasn't a good idea. I'm in crypto. I know there's still a lot of believers versus disbelievers, right? I'm not an evangelist. I don't say everyone you have to get into crypto, but I think the market has evolved and developed. I think it's keep your minds open and take another look, do your due diligence, and there's
Have a little courage.
Yes, of course. In all strategies, I think you need a bit of courage. So I think 2023 could be quite exciting year.
I think I'm going to agree with the panel before our panel that was really into capital preservation. So I think that if you look at most of the family offices, the reason they have so much exposure into real estate is because they understand that area. If they have multifamily offices, they have the asset, they have the collateral, they have the rent. So it's like safe. So I think for you unless you have like an additional portion of your capital, that's going to be my risk. To go into alternative asset alternatives, like we'll talk about all these IP, crypto, you need to have somebody who understands that in the family office, and you won't have it because most of the family offices are not large enough, like the one that I work for, right? The 50 people, 50 analysts. So how are you going to understand your risk with all those alternative asset strategies? You have some advisors, but I think that if you want to be exposed to crypto, it'll be much easier to be in a fund than invest directly in FTX, and then you don't have the disaster. This goes, I think, with every alternative asset strategy. Like, for instance, I don't have any knowledge about private credit. If I were a family office, how would I now going to invest in private credit? It's great. Everybody says it's great, but I don't have the knowledge. I need to have somebody who has the knowledge to guide me through that, and that I can, then I just monitor the performance of that manager. So I have a different
there's
opinion.
a learning curve basically always.
I'll provide a counterpoint.
Yeah.
So I think that the assumption there is that alternative strategies are necessarily complicated and complex, and that's not necessarily the case. There are complicated alternative strategies. There are ones that aren't. We're simply lending to small and medium-sized businesses. Most single-family offices who've been successful understand the nature of lending to businesses. The question is, can you find managers or companies that have carved out a niche, have a moat, and can deliver that on a consistent basis? Yes, there are going to be very complicated strategies that require an outside advisor, but I would assume that most successful family offices have a pretty good understanding of credit, equity, lending in other areas, and there's a lot of very interesting esoteric asset classes that provide opportunities for single family offices that don't necessarily require outside expertise to understand the core strategy. There are certainly that do, and for those, I 100% agree with you to recommend it, to find someone. But I don't think that you have to have an alternative and complicated to be something that is one and the same.
So how would a family office learn about investing in IP or crypto? I'll let you start.
Well, I think
with
part of the reason that we are here,
Yeah.
offering our expert, and,
Good.
you can reach out to us. But I also want to add to that because my background is a trader. I was a trader at JP Morgan, exotic derivatives, commodity futures, coming up with strategies, serving institutional clients on beta, smart beta, or pure alpha strategy. So to me, one should never shy away from risk. Risk can be managed, right? You don't want to crypto. I'm not advocating you should have 20%, 50% crypto. Have it 1% or 0.5%. See how it fits into your portfolio. Have someone, definitely do your due diligence, gain the knowledge, but then see how it fits into your portfolio. It shouldn't be, this is too complicated, it's too risky. Let's, there's a way these things can all fit together in a way to boost your portfolio.
So I'll talk a little bit about what I'm doing. I spent 25 years investing in with companies that had fundamental IP being tech, breakthrough innovation. What you learn when you play in that space and you invest in scaling the use of the engine in the car, you're no longer betting on the team driving the car, you actually bet and underwrite the value of the engine in the car. And you look to partner around the world so that there are many teams using your engine, and you collect a royalty or a total amount of revenue. It's used in the drug space a lot. So I've taken kind of that drug model and I moved it into high tech. I moved it into high tech because there's a great report from the Boston Consulting Group in May of 2021. So you don't have to just believe me, but what you learn there and what I've experienced is that the world after the dot-com bust went to software, digitized the world. And of course, I don't know all the strategies out there, but when you're looking at early stage revenue companies in venture capital, it's mostly software and healthcare that's funding today. So I moved into hardware because hardware companies, people who manufacture physical products, are actually changing the game in manufacturing, and that's where high margins and high growth exist. Except they can't get venture capital today because you built your fund on investing in software. You can't just shift gears, and they have a 10-year time frame to them. So it's very, very slow to move to meet the capital need in the hardware space. And it's compounded by the problem that we shipped all our hardware overseas, manufacturing. So we have a national security problem today, and a need to bring manufacturing back, and a need for a new model, an IP investing style model that invests in the engine of the car. And a lot of these companies underwrites that, holds that as asset like a piece of real property, collects a toll on revenue for helping these companies scale. And so now I have a real property like investment style in venture capital, revenue sharing instead of equity, which is really a lottery ticket. So think about real property, asset backed and cash flowing. And you distribute those cash flows to your investors at about an average return of 12 to 15% per year, but they still hold the ticket in that exit. So they're paid to wait, their capital is protected, and they still hold that lottery ticket. Now, we don't get the same stake in the outcome as a venture capitalist, but I'm playing from the downside up, not trying to swing for home runs, but doubles and triples. So it's a really simple model and a simple concept in a space, hardware, where nobody's playing things. Very, very hard to get capital there. These young companies can get, you'd be shocked, 10 million, 20 million, 50 million from strategics to get to market. But when they get to market, private equity wants them a little further along, too much execution risk, and venture capital has moved to software. So I moved in with an IP investment style that's used in movies, it's used in making, in mining and oil production, it's used in pharma, but it's never been used in high tech. And I want to bring the people into this asset class because they know there's real value in that engine to protect your capital, shadow rating, credit rating, long term. But I imagine a world one day where on your capital structure and your capital stack is equity capital, debt capital, and IP capital. And IP capital fits a need and has a different risk profile and a different return profile that's matched to what these companies need to grow. And we're starving these companies today because we live in a box and we're afraid to come outside the box. To your point, that most people don't want new alternative strategies because it means they need to think, they need, to her point, they need to bring talent in because they're afraid to do it themselves. And so that's a real problem. And if we want to turn the country around, investing in these kinds of companies will bring our manufacturing base back.
Thank you, thank you. And you answered the question of how your fund is distinct. So Blake, do you want to, we'll go around with that question now. Do you want to?
Yeah, I was just going to add, so is your model kind of like a Qualcomm?
Yeah.
It's not a Qualcomm has a lot of base patents.
Right, so it's not a Qualcomm model. So I'm actually investing in the company like a venture capitalist. And I invest in the engine of the car because high barriers to entry, right? It takes a long time to copy. Unlike software, a lot of these VCs don't get returns because even if they pick the best company, it can be replaced easily. So I'm investing in that and I'm getting a share of revenues from helping you build out manufacturing capacity, operations. It's not about patents. The patents only come into play to make sure that that asset not only has long times to develop a replacement or competitor, but has protection to slow down that competitor from trying to copy to catch up more quickly. And trade secrets for everybody, even though you'll see a lot of background in patents, Qualcomm, et cetera. If you're gonna build a business, you keep it secret, like Coca-Cola. It's often hard to do it, and you patent what otherwise somebody could see visibly.
Of course, they haven't. Thank you. So how is your, sorry, so how is your fund distinct? You know, what is it that you are doing that no one else is?
Right. Maybe a little bit of background. My friend Wilshire Phoenix, a few years ago, our backgrounds, my partners, traditional finance, we looked at crypto assets and the public market. We thought there was a deficiency in investment vehicles. We saw there are private funds, that digital asset funds, but there's no liquid secondary market. But then there are publicly traded liquid funds that have secondary markets, but they do a really poor job of tracking the underlying asset, whether it's Bitcoin or Ethereum. It has huge premium discount. So we thought let's fix this problem. But it turns out the solution is much harder than we initially anticipated. The biggest challenge was regulatory hurdles, and it's unfortunate today that we're in a law office that feel uncomfortable how much money we've spent in the last couple of years just on legal fees, going down to the SEC and working with the regulators.
We love you guys.
Thank you very much. But I think the the reward is going to be there. We didn't do what everyone else is doing, doing the ETF. We're coming up with the working with the SEC. It's not fighting. I think that's the wrong route with regulators. We're working with them, and it's not also about doing everything that they say, but pushing back in a collaborative manner. I think we're close in terms of getting our product approved into this coming year, the next quarter. So hopefully we'll be able to launch a product that's publicly traded, efficient, liquid secondary market, and able to track the underlying assets, say Bitcoin and Ethereum very closely, and has the highest regulatory compliant and protection that's currently deficient in the market. So I think for family offices and for retail and institutions in general, we hope our products will be a good way for people to access getting to the crypto market. I'm definitely pretty excited about that.
Great. Let's go to Charles, to you, and then I will look onto you. So how is your fund?
Sure, we're a little different. We're pretty down the fairway concept, but I think pretty different. Libertas, we're providing growth capital, acquisition capital, working capital to Main Street, small and mid-sized businesses, up to $10 million. We underwrite that for less than a year. And we allow single family and multifamily offices to participate side by side along with us, where they can earn up to 19% on an annualized basis, with a weighted average duration less than a year. We also offer a 2% first loss protection for every single monthly vintage that they participate in. It's an area. Why is it different? It's because traditional finance has pulled back from this area of the market for decades. They continue to do so today. And it's an area that has not seen an institutionalization. There's a lot of very small firms that have very questionable approaches to the market. Our founder, when we built this business 6 years ago, saw that, wanted to create an institutional product. And rather than create funds, right, all of our partners have their own bank accounts. They participate, carry with us.
So there's no 220.
There's no fees at all. You participate alongside us. Why do we allow that to happen? Because it allows us to provide more capital and larger capital to our partners.
And what's the minimum investment?
So we like, partners who come in with at least $10 million. Again, we don't want to be allocating these deals across hundreds of different partners. But at $10 million, you can get a very diversified pool of advances and loans, and again, get a 2% first loss protection that Libertas puts up on our own balance sheet. So it's lending to Main Street. It's a niche because that's not where big business wants to be and Wall Street wants to be. And there's really no organizations that have sought to institutionalize that space. And we did 670 million of it last year. We'll probably do $1 billion this year. And so we have opened it up to single and multifamily offices to participate side by side with us.
So having had that experience with the large family office trying to make direct investments, I then moved and I joined a few months ago an organization called the K Funds, which only invests money for family office. So they started in 2014, only investing money from families from Utah, because Gary Post was the person who came from McKinsey and all these companies, was entitled. They said, listen, we want to be in those companies, but we don't have the knowledge. We don't have the resources to understand companies. How can I get into growth companies in technology, all this cool stuff? Can you help us? So they started, and they are in the third fund. We're raising like the rest of the fund now. It's $100 million. We 50 million north. But what I like about the K funds is that, number one, only works for family offices, ultra wealth individuals, and multi-family offices or advisors to families. So we don't manage money for pension funds, for insurance companies, only that segment. And why? Because the way that they put together now, I joined the fund, is number one, we only invest in companies in technology that we understand, that is easy to understand, that we know that they are growing. We don't do like seed stage, it's growth equity. So we have invested in companies like SpaceX, like Gerck Market, let's talk about Hello Alfred and Chewy. So we also have exposure to one company that is fintech and has crypto involved, but it's something that, so we go into those other areas, but we don't have like, 100 companies in the portfolio. So each fund is going to have around like 10 companies that we know really well. And the reason that I came into this fund is because part of that strategy is also to allow the families to participate in the investment of the companies themselves. So what is happening right now, so for instance, SpaceX. We invested in SpaceX. Once we understood the model well and the SpaceX needed more money, they gave us a chunk that we could invest, and we put together an SPV, went to the investors in the fund and said, they want to invest in SpaceX only. Then we manage the investment, we go for that SPV, and of course, if you are investing in the fund, the cost for the SPV is zero, right? And so now we're doing that right now. I told you yesterday with Hello Albert, which is a prop tech company that does the management of properties, and they also invested in properties. So they have investors like Greystone, like Cerberus, like Invesco in the real estate side, and they have the technology to manage those assets for the property managers and for the renters. So if you want to invest in Albert today, they're raising $50 million. No family office will get in because it's oversubscribed with JP Morgan, with Cerberus, everybody else. And then you can get in through us. And that's why I like about the K funds, that it gives these opportunities of direct investments through the fund to family offices. The other thing that I like is that it's a cozy environment. They have like golf outings. You can call anytime. So I got to learn the K funds because when I was in the large family office, I could talk with them. You call, the big companies, you have to talk with the associate, the analyst, I don't know, whoever's cleaning the floor. There, I talk with the fund manager directly. So, and that's what I'm doing now. I'm working I'm also on the board of a seed stage fund, but this board I'm very, right now involved, and I love it, and it's dedicated to family office.
Great, thank you.
My ears perked up when you said golf outings.
We don't offer those.
So we allocate capital, and it's a combination of occasionally allocated capital to individual companies. One of the things that Pete had mentioned that is a great arbitrage, if you will, is looking for companies that have non-dilutive DoD, DARPA money. We're investing in a company that raises money. They're raising $2 million on a $20 million valuation, but they've had $20 million worth of DoD funding going into their technology. So it's
private-public partnership.
Yeah, well, yeah, and it's serving the needs of the DoD and it's serving the needs of the company. So that's just an example. And also looking at kind of, again, alternative. We've got a finance company in Canada that basically acquires the royalty rights to the offtake for renewable energy. So if I'm a developer, I do the permitting, which is very high risk, very expensive. I do all the geographic, whatever that might be, for a alternative energy project, and I turn $1 million worth of permitting and risk into maybe $10 million. Well, my value is a bunch of royalties on the offtake. So rather than, in order to do another project, this company will come in, provide capital to that person, get the royalties, he'll be able to monetize it, or she will do another project. And it's short-term loans with long-term royalties attached to it. So it's highly collateralized, 9%, but that's the kind of thing that is in a private credit environment that kind of makes sense if the macroeconomic view, which we saw earlier this morning, comes to fruition. I want to be backed by things like alternative energy. I want to have some guarantees up front, et cetera, et cetera. So that's what we do.
All right, since you mentioned the macroeconomic view and, projecting maybe 2023 and next year, why should a family office or an allocator look at your strategy? Like how's it gonna play out, you think, right, in the next 2 years?
Yeah, sure. So, at Libertas, we don't do anything longer than 12 months. And so what we've seen is that as a result of what's going on in the economy, the traditional financial providers have been pulling back. And so interestingly, in our book, we've actually seen the credit quality of our portfolio go up. Our defaults have actually gone down. And we would expect that trend for Libertas to continue because again, as we go into these periods, those traditional financials are going to pull back, they're going to tighten their credit box. That's actually going to send more and higher credit quality companies to firms like us and to our partners. So we've been a beneficiary of a bad economic environment. And by the way, that should be the definition of any alternative investment, right? It should be counter-cyclical in some way, shape, or form. So uncorrelated. And so, for example, last year, participants for us, earned, mid-teens net returns, just as they did the year prior. And the reason for that, again, is because we have a very different type of strategy. And I think for Libertas and partners of Libertas, they should actually look forward to what's happening because they will benefit from that as a result of partnering.
Wonderful. We'll come to you in 1 sec. Let's just go back and
okay. So the K fund is a growth stage. So as we heard, it's not a type of private equity because private equity is being hurt because of the high, they cannot do the leverage for the returns. So the growth stage, what I like is that right now we can buy companies at a cheaper valuations because the market's going down. I don't think it's going to be there forever. So for the next, as I said, 2 years, 3 years, we can get great acquisitions and we're diversified across many sectors of growth companies in the United States only. We believe the US will continue to grow. We also invested in impact investing, like I just said, Alpha, this women-led company. We are in some companies like SpaceX and some other companies that are, impact investment also in terms of impacting the society. So we have all these companies will continue to diversify like that. And I think that is growth equity. So as the economy grows, we'll continue to grow. I don't believe in a recession. Never did, and I still don't. I think we'll continue to grow, and it's good capital preservation, and you're exposed to the cryptos and prop techs of life with a manager that is really, really well experienced with a 35% IRR. And I like that strategy. It protects capital, so that's why I like it.
Thank you.
Thanks, Julie. Maybe a quick, our thinking on the crypto markets, especially last year, 2022, has been interesting for Bitcoin and crypto. One of the benefits of crypto is high rate of return, also decorrelation to other asset classes. So prior to 2022, let's say 2018 to 2020, correlation to Bitcoin to S&P is, let's say, 20-25%. But last year was really interesting. Bitcoin really proved itself as a risky asset. The correlation between Bitcoin to S&P is more around 55-60%. So, puts down the argument it's inflation hedge or it's digital gold. But there's also a flip side of it. Even though you lose some of that correlation benefit, we see Bitcoin and crypto market actually maturation, because it no longer trades its own kind of silo doing its own thing. It's taking signals and cues from the broader macroeconomic market and other asset classes. So we see some similar things happening in 2023 when things are coming down and the correlation actually coming back. So you get kind of the best of both worlds. And maybe a really quick comment about FTX that was mentioned before. When it first happened, it gut punched the market and it was bad. A lot of people got hurt. But it's actually turned the market sentiment towards more regulated, compliant, and protected both products and entities. So I think that's a positive thing for the market and space overall. I think in 2023, well, actually, the market has recovered quite well. January was one of the best months for Bitcoin, up 40%. So I'm hoping that the market will stabilize. And so with that background, I feel our product coming out to the market is offers family offices and retail institutional clients alike a way to easily access the market. And look, I think if you are still on the sidelines or a disbeliever, I don't blame you, because I was at JP Morgan. Our CEO allegedly said he will fire any trader that trades Bitcoin. But things have changed. This was several years back. Markets have evolved. JP Morgan, along with all the major banks, are offering crypto products, services to their clients, trading desks. So take another look. I think there's a lot to be had looking at crypto with its benefits. And I think our product that's coming out that's offering efficient access, ability to track the underlying asset closely, and higher regulatory clearance and compliance and protection would be a good way to enter the space. Definitely, come talk to us, or our distribution partner, Oasis Port Markets, is also here. Definitely catch one of us and talk to us.
So I'll say a little bit, so when you think about a down economy, people will have 80 cents, they just don't have $1, but they're spending that 80 cents on something that has value. It's all about value in life, and if you deliver value to me, it doesn't matter whether it's a down economy or not. And so if you want to be an investor over the next few years, you want to focus with somebody like me who's underwriting the asset value in these hardware companies, creating a cash flowing product. And you want to do that for a couple of reasons. One, these early revenue companies have a diamond in their pocket, an engine that delivers value you can't get anywhere else. You underwrite their pipeline of contracts, and you get comfortable that that value is actually realizable in pre-sales as well, or sales as well as the pipeline. You have durable revenues in a down economy because they're delivering value. They have durable revenues. And so it's not just a startup that you're sharing in revenues with, it's a material company with a real asset base, high barriers to entry, nobody else has that asset. And if you can underwrite the contract base to get comfortable that those revenues are durable, you got one heck of a product in a down economy. Now, I want to add one other thing. The world is moving to hardware. Why is the world moving back to hardware? Well, software is slow on a computer, but hardware is fast. Anything you can do in software, you can do 100 times faster on a piece of hardware. Cost of building hardware, real physical products, has come down dramatically. We're moving from software back to hardware. That's a trend. And two, what's driving a lot of that is sustainable and circular manufacturing. And what is that? Code for efficiency. We call it green. A lot of conservatives reject that notion, but the truth is, it's changing the economics in manufacturing. So it's high growth and high profitability. It's a Qualcomm-like business with 50, 60% EBIT margin, not 5 or 10% in manufacturing hardware products, which is the reason we moved everything offshore. Right? We needed low-cost labor. And so if you're looking for a place to put your money, not software companies, dime a dozen, too many venture capitalists chasing too few deals, that equity holdings, and equity is a lottery ticket. If you actually, Hoffman Foundation did a report 10 years ago, and they showed that over 100 funds that were getting a 1.3x return on their money and a 6% IRR. Come to my model, and I have about 20 years of a track record on this. It's a 5-year run that we model. We're giving investors a 12 to 15% yield over that 5 years. And then an all-in 2x, 20% IRR over the 5-year period. You can't get that in venture capital, but it depends on a guy like me. To her point about needing the skill inside, how do I underwrite that value? What do I do if I have to liquidate that asset value? The IPS, not patents, not trade secrets. It's the brick and mortar. It's the equipment that I'm helping build out that has value. If I get comfortable that that value is there and it's liquidatable, I have an asset like a piece of real property. It's not an intangible asset at this point. Is to build anything, the idea has to become physical. And I have durable revenues if they truly have something that's highly differentiated. So I'm building a product that's fitting a need today. These hardware companies, to finish one last point, many great companies are available today. You'd say, why is that? Well, venture capital loves software, not hardware. And when I talk about hardware, I'm talking about renewable energy as well, solar, housing, industrial companies that you would never think about, that you wouldn't hear about in the press. But here's the important point about why these companies, why you can get access to great companies. In a down economy, the multiples on earnings and on revenue are low. So equity comes in at super high cost today. So the best companies are available when you bring a revenue sharing model, right? To them.
We are not in a down economy, but that's okay.
You don't dilute their equity.
But please,
What's the question?
any. So.
That's an excellent question.
Yeah, good question.
All right, so we've been talking about we kicked it off with the macroeconomic environment, and what do you think the next couple of years are going to bring, and how are you advising your clients, Joe?
So, yeah, I thought his presentation was excellent, right? And my father was all in the business forever, and he always made said something, he said, if you're gonna predict often.
Mhm.
And, I try not to look at macroeconomic. I mean, obviously, I think Marty and I have talked about this a lot, which is we're looking down the road, we're distressed, maybe
Yeah.
some really interesting opportunities. And I think we're stressed, but not distressed right now. But I think it goes back to looking for businesses, looking for strategies that have moats around their business, that offer a service that is currently needed. It doesn't have to be macro in scale, but providing financing in a certain way, providing financing for alternative energy, looking for emerging companies that have a solution to something. I think that transcends the economy. I think when we start thinking and talking about asset classes in general, then we start talking about macroeconomics. But I really try to focus it on individual opportunities and look at them as businesses rather than an asset class.
Yeah, is it a durable business model?
Exactly.
Right.
Irrespective of where you're at in the economic cycle, is it a durable business model? So I couldn't agree more with that assessment.
Okay, excellent.
Actually, I had a question for Robert. Hey, Robert, so just perspective on manufacturing and like all these new areas like space and things like that, where people are building new equipment to go out into space, et cetera. There's must be a lot of intellectual property involved in that. I'm sure there's tremendous growth. Do you have any data on like what the growth of intellectual property in those
I don't have
segments?
the data, but I can give you, so I'm partnered with a humanitarian fund, basically, and so we'll buy on both sides. So we'll both make the investment, help you scale out, and you'll also have to allocate a certain portion of the line, and we'll buy that offtake for basic housing needs, food, energy, clothing, medicine, et cetera. So I'm in a kind of a special spot for this business model, and we'll be providing allocations to an accredited investor audience, family offices, if they want to participate, take a shot at what I'm doing, look under the hood. I was worried about the hooks, but what we're doing is well capitalized. We're looking at $1 billion into 3 projects to give maybe a little context to what I'm doing. One is textile. So we're actually scaling lines. The first is built, one in Europe, one in India, we're building in North Carolina. They take waste, textile waste that you can buy for next to nothing off the factory floor or out of the recycling bin, next to nothing. Like,
is it going to space?
What?
Is it going to space?
It's not going to
go
to space.
Oh, okay.
And turning it into virgin fiber again. So instead of recycling, which turns out to produce a downgraded quality product, you can actually turn it into virgin quality. And let's just say, and I can't name names, but let's just say we have offtakes with some of the major brands that you would know who couldn't find a solution because they're all, and this is the thing, the pull-through demand for these hardware companies is all sustainable and circular. I, as a company, whether it's BlackRock or whomever, has put me on a quarterly plan to show I'm headed towards efficiency, sustainable manufacturers, circular. So this textile is very, very cool because I can take a low-cost input and turn it into a high-value output. And now I have a high-growth, high-margin business, and everybody needs it because they have no other way to meet their sustainability goals and their circular economy goals. I don't know if it answered the question, but it gives you a little context of what I'm doing and why it's powerful.
But let's open it up for questions. Any questions from the audience?
I wanted to say one thing that I noticed here, because we talk about a number of alternative strategies. And 2 years ago, we talk about crypto was great, and Will, when we were rehearsing for this panel, he was like, I do crypto. And now he's like almost saying, I'm sorry that I do crypto. I went to meet you 2 years or 3 years from now, and I bet you're going to be very different because of the cycle. So right now he's like, I'm sorry, I do crypto. Who knows what's going to happen 2 years from now?
I think the issue is volatility. Right? It's the volatility of crypto, right?
Exactly. And that can be
regulatory too, right?
Correct.
Obviously, things are going to change.
That can be harnessed and managed. And regulatory front, I think steps are being taken. I think people are looking for a comprehensive framework, but that's difficult. Crypto is not just Bitcoin. It's DeFi, it's stable coins, it's CBDC. And unfortunately, there is a bit of regulation by enforcement, but I think the SEC and the regulator is tackling piecemeal. And right now it's supposedly crypto winter, but to me it's crypto opportunity time.
I just have one quick question before you go. How much of the market is Bitcoin as a total crypto value?
I think it's still around about 40%.
40%.
It fluctuates as
I thought it was higher.
yes.
So I'll bite. So crypto is where we should be. So this is not the first time I've asked this question. I'm still waiting for a good answer.
Okay.
So give me the bottom up argument for why, whether it's Bitcoin or any other cryptocurrency, why it's currently undervalued and what the force is that will make it worth more on a sustainable basis.
Okay. First part, I was actually thinking about this question before coming here, and I think if you're asking me this question now, I don't think I'll be able to convince you actually, because you must have heard all the arguments since 5 years ago, 3 years ago, and now. So, but that's okay. Like I said before, I'm not a crypto evangelist. You don't have to have crypto, and it's not going to solve all the world's problems, crypto or blockchain. But it's here to stay for sure in terms of adoption. As I mentioned before, the big banks are
more substance. You gotta
offering.
give me some substance. What demand case is there for why, whether it's Bitcoin or Ethereum or whatever,
Quick argument.
why it's undervalued?
So I'm going to table this question because we have a lot of
Talk offline.
Pantera will be here tomorrow, right?
Exactly.
So Pantera will be here tomorrow, and they invested in FTX. So they're gonna have to answer for that. So
Let's chat as well.
right? But my question is I see the use case for Bitcoin. I see the use case for all of the many projects. I don't see the value of the many projects, right? That the high.
I'm not a crypto blockchain expert, and I'll just add my 2 cents here. I think there's a difference between blockchain and crypto. Crypto is a use case for blockchain.
Totally.
So whatever the intrinsic value is for any of those is different. Ethereum has gas fees. There are different use cases for every one of those crypto. I think if you're a family office considering blockchain or crypto right now, I think A, you need to separate those two. And B, if you're really looking at growth, in my view, blockchain is the actual technology that you can be looking at, whether it's Web3, whether it's every single mortgage on JP Morgan right now is using their own R3. I think the question for your ask is, there isn't a one size fits all answer because some have use cases like Ethereum, some do not, cross-border. But I would suggest that blockchain as a technology is really the investment case.
I agree 100%. The dichotomy is clear, but Will was stressing crypto, which is what was really sort of pushing my button.
It's very hard. I think it's very hard for anyone to make an intrinsic value case for crypto other than those that are used for financial service transactions where you are effectively owning a piece of the net present value of all of the fees that will be derived on that chain on a go-forward.
And we're going to table that for Pantera. Actually, I have a question. I have a question. Okay, ask this question.
100% agree.
Charles, I have a question about your platform.
Yeah,
so
sure.
Is it pretty much a peer-to-peer platform where people just pay to be on the platform?
Nope. No, it is not.
How do you make money?
We make money because we are side by side with, so we are providing balance sheet capital to those companies as well.
Are you the underwriter?
We are the underwriter, we're the originator, we're the underwriter, right? We're also the servicer in the case something goes bad, we're the collection. So the reason why we allow partners to come alongside us is twofold. One is it gives us some scale, right? So we can do bigger deals. And the second is it allows us actually to be more aggressive on pricing in the market so we can win more business, right? There's already enough, if you will, juice in what we're doing to allow other providers in, but there are no fees to participate. And we do not charge any management fees alongside us. You are literally sitting, Perry, next to our balance sheet capital. And on top of that, to get you to come in, we'll provide a 2% first loss protection.
But you charge service fees to the companies themselves, right?
Sure, but not to the participant.
Not to the companies are the.
Sure.
Is this actually lending or is it something else? I mean, you don't have to be a licensed lender.
Correct. These are advances, right? So we're buying future revenues for a discounted price today to with factoring. It's effectively a factoring company.
Okay, I just wanted to clarify so everybody would know better.
Yep. And while 5-year money is great, and I think what's being done over there, our average duration is about 9 months.
You have a 9-month duration.
On average, our duration has always been around 9 months because we have a lot of education. We offer a lot of ours for participants is up to about 19%. We prefer kind of $10 million in it, right? We don't, and the reason for that is a couple fold. One is we want to ensure that you have a diversified vintage, right? So you want to have a lot of different advances in each vintage. And the second is we don't want to necessarily have to allocate to hundreds of different partners, right? We want sizable partners that we can allocate.
What's the lockup, a year?
There is really no lockup. It goes into runoff. So when you make that advance is over 12 months. It gets paid back daily, weekly, or twice monthly. So the actual capital recycle is very, very quick. And the only thing is if you want to stop doing it, your portfolio goes into runoff, and on an average weighted basis of 6 months, you have all your capital back.
What's the structure of that? It's like a special purpose vehicle? Does it like create an SPV for each client, or how does it work?
You have your own account. You become a beneficiary of a DACA account, if you're familiar with what that account is. All the cash flows come into that account, and then those cash flows get distributed pro rata directly into your account. When we need to do a capital call, if you will, or fund in advance, we simply do an ACH pull from your account. So you set up your own account, it's at your account.
Why not set up leverage on top?
Nope, we do not, no leverage.
You're originating
100%.
18-19%.
Correct.
So why not set up a fund?
A part of it is the.
Why not set up a
recycling.
fund? Great question.
Right.
The answer is because we have no desire to be a registered investment advisor.
You don't have.
Hardcore, you do. Once you get over a certain percent, over $100 million, you got to register as an investment advisor. We don't need to do that. That's not our core competency. Our core competency is providing financial
Well,
services.
you can get someone else to say that.
Correct. So we do have a number of RIAs that we're talking to, and we effectively provide a fund in a box. They can take and wrap it with a 3C7 and 3C1.
You do that.
We're already doing that. So if there's
Well,
people
I'll
that
let you
want,
know that I'm doing it.
happy to do that, right? So effectively,
Use
you,
19%.
a lot of people could, especially with a duration of less than a year. And by the way, for those RIAs, for those funds, that 2% first loss is still part of the agreement.
Okay.
What's the capacity for the strategy?
So we did 670 million last year. We'll probably do $1 billion this year, and we target $1.5 billion the next year. This is a huge asset class. I use that in quotes because nobody's really talking about it as an asset class, Main Street lending. But you know, there are trillions of dollars that go out to Main Street every year, and the banks and the traditional partners are pulling back. And if we do go into an economic climate, I'm not going to debate whether or not we are or not. Those banks and those traditional financial providers are going to pull back even further, and that's what we've seen. And the capacity will actually go up. Yeah, Kirk.
Yeah, just a quick word on deal sourcing.
Sure. For deal sourcing, we get from a variety of players. We have a ton of referral partners, whether they're independent sales organization, banks, investment banks, traditional, my old haunt at Angelo Gordon and other firms that turn down 90% of their deal flow. So we have a very diversified base. And the nice part about that is a lot of those deals, especially from the institutional side, are in some ways already pre-vetted. We're still doing our full underwriting. But you know, we have a variety of deal sources that we get there. Yeah.
Default rate.
Our default rate has been about 3% historically. And that is in the industry about a third of what traditional happens in the industry, if you're familiar with it. The reason for that is because we deal with larger companies of higher credit quality, and we also do full underwriting. So we don't just look at bank statements. We actually do, and have taken the approach that I did at Angelo Gordon and my colleague Dave Whale did at Deutsche Bank for 30 years. We do full underwriting, but we just compress that, and rather than look out over 5 to 7 years, we're underwriting for 12 months. Very different approach.
Default rate across cycles.
Yes, yeah, that's since inception. And anybody, by the way, any partner that wants to come in, we'll provide you with our full deal tape back since 2016. You can verify all those numbers. But it's not a fund.
Right.
Not selling a fund.
Questions? Any other questions?
There were some Bitcoin questions. We're going to ignore those.
Come on.
Somebody said somebody.
Yeah, go ahead.
Yeah, so you described the K fund. It just sounds like a VC fund to me with.
Yes, a growth
Coinbase.
equity fund, yes.
So there's not some distinction.
No, it's a growth equity fund, later stage. We have golf outings and a lot of great
golf
outings.
outings do not come with.
Yeah, we do golf outings, we do other outings with the family, so they know primarily the families that invest directly in the companies that we invest through the SPVs. So it's a VC fund, not VC, it's a growth equity fund because really like later stage. And then when investing in that fund, you can be, invited to invest in the companies that we invest directly as well. Like, just said, hello, Alfred and SpaceX. So the advantage is that we work only with family offices. Family offices want to go into a later stage, and I leave that in a later stage investment in the company. You can get in because the later stage is less risk, is like in series C, D, E. So they're just like raising before they do an IPO, just because they want to go a little more. You can't get in because all the funds are going to be there. How are you going to get in a deal like that? Now, if you are invested in a K fund, you can get into those deals through us.
What's the fund life?
It's 7 years. And so far, the funds that we have, the two funds, one that started in 2014, the one that started in 2017, the return has been 35%. And we just started this new one, and we're fundraising for that, PVPI. Yeah. So just email me. I can send you more information.
Yeah.
And I'm on LinkedIn, so easy to find me. My last name, I'm the only one.
Yeah. All right, closing statements.
Alter on what they used to be.
Good, excellent.
Well, I think that alternative strategies are risky. They're all like great, but I think you need to have somebody who knows to guide you for that. Like I agree with the other and with the other panel about like capital preservation. And then I'm advocating for the K fund because it's capital preservation, the opportunity to be an investor directly in companies that you're never going to be able to be there. So I like that. So now I have to say something good about it.
Oh, God.
Yes, yeah, no, we're excited about 2023, and I guess my main thing is you don't have to like every strategy, but do your due diligence, keep your mind open. And for us, I was saying before, crypto winter has been tossed around, but to me, it's crypto opportunity time. Really, if you do your due diligence and decide to pull the trigger, you're not buying at the highs. It's that's a lot of concern when on Bitcoin, crypto is always going up. So yeah, come and talk to us.
Thank you. Thank you.
So IP investing is here to stay. It's replacing equity investing. Equity investing today, I like to call it pump and dump. I'm going to offend people, but often those returns aren't there at the end of the fund life, especially in the software world. A lot of competition, low barriers to entry, and so where I'm investing, I've got a 10-year track record, which is laudable, $1 billion return, 112% IRR on what I do. Especially picking companies that are highly differentiated, betting on the engine of the car, not simply. The world is moving to hardware away from software, and the only way to really help scale these companies, and they have the benefit of bringing manufacturing back to America, is to fund them in a way that shares in revenue and lets them own the business. They're heavily diluted by the time they get to market. It takes 5-10 years to reach market in one of these companies. And so I am a Qualcomm-like model in a lot of ways. I help you scale the corporate stores, and then we're focused on how do we protect that engine in the car and share it around the world through licensing and franchising arrangements. So we have many, many teams creating value. So a company can grow bigger, stronger, faster, with much less risk than living in a venture capital world where you have no security, you have a lottery ticket for 10 years, and returns just aren't there. So go to cotecapital.com, COTcapital.com. You can see some of the deals that are posted there. There's more than a textile deal. And if anyone has any questions,
Thank you.
Yeah, just closing. Look for strategies that are businesses. Look for people that are actually adding some value, that have identified some type of arbitrage or something different. Don't be afraid to identify strategies that may be capacity constrained, because that'll keep a lot of the big allocators out. But there's a lot of spread and juice in small capacity constrained strategies. And really look at your allocations as if you're investing in a business, even though it may be a fund, even though it may be an individual company, obviously that's business. But I always try to consult people to go back to kind of a Warren Buffett model, even though it's alternative. Look at it as if it's a business. Yeah, thank you.
Great job.
Great panel.